According to Michael Burry, we are currently in the greatest speculative bubble of all time in terms of the financial markets, and very soon, inevitably, we will be experiencing the mother of all crashes. And specifically, Michael Burry is referring also to cryptocurrencies and meme stocks. He has recently returned to Twitter and he's been sharing these really terrifying predictions for most people. Now, who exactly is Michael Burry and why does his opinions matter? Well, for those of you who don't know, Michael Burry is a legendary investor. I've actually talked about him in my last video on the Black Swan. However, for those of you who don't know, he was featured as a character in the movie The Big Short, which is really a true story. What happened was he accurately predicted the 2008 housing crisis. And he actually shorted, he went against the market and followed with his convictions of his belief. And indeed, the housing market crashed, which led to the 2008 financial crisis, where everyone else was suffering. He actually made $100 million. To date, even if you were to discount this great achievement, which does show his amazing abilities to really understand the markets, his fund that he's managing, the Scion Capital Fund, has actually generated a net return of 475% against the 5% of the S&P 500 from 2000 until this year. So definitely he is an amazing investor who clearly understands the markets. Even with regards to 2008 financial crisis, he actually tried to warn people about the housing market bubble that was happening at the time, but no one really believed him, no one really listened. And I suppose because of that, in the context of that, he's even written a tweet recently that he said this time he's warning everyone, and of course he hopes no one will say that he did not warn us this time, and that he's very serious about his beliefs. So why does he think we are in this speculative bubble, and why does he think there's an imminent crash? Well, to really decode his beliefs for you, essentially Burry thinks that at the moment, if you look at the current situation on the macroeconomic perspective, what you will see is that for most economies, especially the US, which is the one that he's primarily referring to, at the moment, interest rates are either at zero or very, very low, and money is being printed in excess, perhaps as a way of combating the effects of the pandemic and what that's caused us. But what that means is that loans are now easily accessible and the debt levels have actually increased substantially because it is now, in essence, really, really cheap to get loans. And so you have a lot of people, whether they're institutional or even just lay people, individuals, actually getting access to this capital primarily through debt. And the whole reason of getting access to this capital is hopefully to make more money. So the people who are taking on this capital are trying to generate returns, and one of the ways they've primarily done that is actually through the financial markets and actually dumping it into the financial market. And largely in recent times there have been a lot of money that have actually moved into highly speculative investments or assets, if you will. And what we're talking about here is certain highly speculative stocks and of course cryptocurrencies. So a lot of money has actually moved into that because of macroeconomic factors. The result of all this money moving into the financial markets, where primarily they're actually driven by loans, by debts, which in financial terms we know as a margin, is that it actually leads to an overall appreciation of these investments. And so what's really interesting is that if you were to look throughout the financial markets over the past few months, even up to the point of last year really, you will see that for many assets, many stocks and many investments, the prices have actually risen incredibly, which is quite significant because if you consider that during the pandemic where most businesses are restricted or affected and economies are affected, it is quite surprising that for many investments we are seeing historical highs. And that really makes you question whether they're actually beyond fundamentals. Throughout the board, whether you're looking at speculative stocks or cryptocurrencies, throughout the board you will see a correlating increase in terms of the prices where they have achieved these significant surges during this period, which counts to leverage positions and these margin positions that are established because of the current macroeconomic factors. So that's one thing. The other thing that he talks about as well is this idea of speculation and hype with regards specifically to cryptos and these meme stocks, these highly speculative investments, where the hype and the speculation and also the fear of missing out has drawn in a lot of retail investors. We're currently at a point of time in history where you have an almost perfect storm of things. We have, of course, easy barriers to entry to the financial markets much more than before because of, these apps like, for example, Robinhood and all these other trading platforms. Even many banks traditionally are now creating avenues for retail investors to easily access the financial markets. And of course, the pandemic, which has resulted in many people who don't really have the ability to work or looking for other means of making money, who are largely at home, and they're all getting into the financial market, many retail investors. And at the same time, you also have the rise of these platforms, social media platforms like Reddit and these Telegram groups where people can get together and coordinate efforts. So you have this rise of retail investors getting into the scene, but they are largely driven by the speculations, by these hype and this fear of missing out, and they might not necessarily be the most financially literate, maybe relying primarily on news and on information provided on the groups, on certain websites, and that's really it, and they're dumping into the market as well. And so we have seen a surge in investing, especially in these speculative areas, which do attract these investors because of the promises of making a lot of money from this. Yet many of these people who are participating, they are largely running on speculation and hype, a lot of whom may not actually invest with fundamentals in mind, which is so important in investments, rather focusing purely on speculation and perhaps on chart plays. And so they're getting into the scene, and we have seen surges in prices from this. But again, many of these things they're investing into, like for example cryptocurrencies, we don't really know exactly what is the fundamental in terms of a long-term point of view. And again, overall, it is something that is against much of the established financial institutions, so we don't really know what sort of response might happen. But the fact is, there is a lot of speculation and hype here. Now, why these two factors are really important is because what the first factor does, what I just mentioned in terms of the leverage, is that it actually drives a lot of capital into the financial markets, which has led to a lot of appreciation of many of these speculative investments. And a lot of lay people who are getting into it, these retail investors, they might operate on the wrong assumption that it is really easy money, that their investment decisions are correct, that whatever they've gone into has actually appreciated, when the overall trend has been like that. So many of these retail investors, they're not aware of the macroeconomic factors, especially in terms of the leverage investing that is actually going on. And so what would happen, according to Burry, is that when it comes to a point when the leverage investors, they have to actually take out the money because after all it is debt, then what happens? So we can imagine the scenario like if there was a catalyst, again fueled by the leverage and the speculation. For example, a scenario where it turns out that certain, let's say, cryptos have basically no fundamentals or no future because of institutional reaction, and it starts to slump, then many of these leverage investors would have to take out their positions because it is a loan after all, and they would have to actually go through what we call margin calls, where when it hits a certain point they have to actually exit, and their exit leads to further downturn of it, which leads to further exits, further margin calls, which leads to further margin calls, and all the way down. In other words, it is a reverse short squeeze position that we have seen with these meme stocks, where these hedge funds were forced to actually exit their short positions because of the crazy pump coordinated by these people on Reddit. The same thing would happen according to Burry, because currently the market positions, according to Burry, is highly leveraged. A lot of the surge that we have seen is fueled by the current macroeconomic condition, as well as large and widespread speculation and hype. Now, what can we take away from this? I think the biggest thing to consider is that it really has been a wild ride this year. I've talked about this in many of my videos that you can check out on my channel, but this year has seen a crazy year in terms of investments, especially these speculative investments, which have surged and surged and surged, and it makes you question everything when you consider the fundamentals and the practical developments of many of these investments people are getting into. But I think the thing we have to be aware of is that we can't be misled by the surges alone, that there is actually more factors at play, and that really is Burry's point, that it really isn't always just going to be an upward momentum and that it will hit an all-time high imminently. There might also be a sudden drop when the conditions change, as Burry have actually predicted many times before in the past. And so that's the thing we have to be aware of. As we are going into these speculative investments, we have to be cautious not to go in under the assumption that these surges would continue. And we have to realize that the surge that we have seen is not necessarily indicative of the fundamental intrinsic value of certain investments that we're considering, especially in the sphere of crypto. Something that is surging is not necessarily indicative that this thing is truly a great investment. At some point when the macroeconomic conditions might change, and that Burry is right, and we start to see a lot of it has been from these leverage investors, and we have to start to question actually what is the real value of a certain investment. And that's the sort of mentality we need to have. Operate on the assumption that what we're seeing now is really smokes and mirrors, and that is Burry's point. So as we're going into the scene, I think we have to be very careful, especially not to be too optimistic, because in such circumstances where this year has been quite crazy, and we're now getting these warnings from people like Michael Burry, I think we have to be extra cautious. So Burry's words are so relevant to us right now.